So let's start with some investment highlights. As Tim said, in FY22 has been a pretty big year. We built one of Australia's largest industrial distribution groups with combined assets, not only ourselves, but with independents, which I'll explain more. We work in a $40 billion market. We do have a track record of M&A growth as well as double-digit top-line growth. Importantly, we have a resilient operating model, which not only is balanced and diverse, but it's also a quality portfolio. We have an extensive range of products, that 95% of those are non-discretionary items, which drives ongoing demand, but also it allows us to push those products through multiple channels and from a stocking point of view, good turnover. We have an extensive opportunity from the events that are happening in 2022, and those events will occur over the short to medium term. We continue to give some guidance on our top line year-on-year growth of plus 10%, 8% EBITDA. Our results are due out on Tuesday. So obviously some of the information I'm providing today will get updated at that time. Move to the next slide, please. So if I just step back today, we have a revenue of $100 million. That is up 46% over the last 12 months. Principally, we're a distributor of industrial supplies. We also have value adds services as well as solutions that cover products to business, to trade, to retail, and also independents. So if you think of Metcash IGA, where you have a local operator owning a store, but they work in tandem with the corporate, that's the model that we operate. I founded the business in 2014. We listed in 2018, and we've been able to build quite a comprehensive group across Australia. Our key product segments also include safety, workplace, truck and automotive, and our industrial services element continues to expand from repairs and rental into etching and also back office services that we provide. Typically, the supply solutions is an integrated model for large customers that require a full end-to-end solution. If you move to the next slide, please. A really comprehensive board and management structure. So Chris Horton's been with me now for 5 years as chair, former head of Seven West Media Assets in Western Australia. John Gropoli is a former lawyer, but also former head of Automotive Holdings as their chairman and Red Division in Western Australia. And Simon Poiterman is the former managing director of corporate for Bell Potter and also was the captain of the Wallabies rugby team. Next slide, please. Simply where we've evolved to today, we're a company for everyone in the workplace. So everyday industrial supplies and solutions. Our ambition is to be a market leader and the main partner for those different product groups. And that's all underpinned by a large interconnected distribution portfolio. Next slide, please. So the business connected strategy is really already cover the products and the solutions element. So, you know, the distinctive business areas are really about aligning the customer types. So the distribution model of business customers has a certain infrastructure that sits behind that, a retailing model, and also the independence model, which works with our top tier 1 suppliers to provide a specialised wholesale service for them. Our channels are actually quite wide, and this allows us to have multiple touch points with customers, whether that be through a sales force that's out in the field or online, but also we have branch setups in stores. We have on-site stores at customer locations. We're online with 5, 6 different channels and also the service. So that's quite comprehensive. From a financial point of view, obviously, we do have a business that has high repeat revenues. We do have ongoing accelerated demand. Our scale now has provided us with the ability to improve margin, not only at a gross profit level, but also at a net profit level. We are a capital light model. Our business, as we continue to grow, will be generating stronger cash flow for our business from the leverage that we've gained. And also, I think with the way that the inflationary pressures around labour and also growth across a number of organisations, we're really well positioned for further industry consolidation. So we're active in the M&A space in the future. Next slide, please. From a resourcing point of view, you can see pretty comprehensive coverage on the right-hand side where we're located. We have 74 locations, 250 odd people. 40% of our staff is women, which I'm really proud of. We have 400,000 products in stock. Whilst that might seem a lot, and the 600,000 lines that we pull on demand, the operating model really is, once we have a product that has a certain amount of stock turns, we will then hold it because the demand supports that. Anything else we buy in on a as required basis to fulfill customer orders. We have 8,000 customers, 34,000 retail and trade consumers, and that doesn't include the operators that go into independent space. Next slide, please. So just to sort of put that in a bit of context, the subcategories of the products we sell are on the left-hand side of the screen. A whole mixed range of all types of products that you can see in a workplace. Equally, the brands that you see on the right-hand side are leading brands. They're just some of what we sell, but pretty comprehensive, which most people would recognise depending on what industries that you obviously associated with. Next slide, please. Our distribution platform or system is pretty simple. So we pull from our suppliers, we're into our distribution centres. We then feed our network with orders from a store perspective, whether that be on-site or independents or our own, and then they serve customers of all different types and sizes. So I guess in summary, for our capability today, we have a large-scale business. We've got high repeat revenues. We've got extensive distribution network where we've emerged across a whole host of different market positions, and our model is a key point of difference for our ongoing growth. So next slide, please. Next one. So let me talk about where we were in FY22. So $30 million growth, a bit over $100 million in revenue. We have a market cap of only $13 million. So with a 46% growth in our revenue and $55 million that was achieved in the second half, clearly there's a bit of a disconnect there. You can see across our markets, our product segments, and also the regions, we have a reasonably good blend. The regional side on the bottom right-hand corner is we were involved in a joint venture in the UK, and we've divested of that in the last 12 months, which has brought the majority of our operations and focus back into Australia. Our segments are very geared at the moment for business customers, and that's clearly demonstrated by our foundations and the industrial element, which is 60% of the products that we sell. It's an endless assortment bucket of products. So that is typically what we would expect in a business of ours. Next slide, please. A transformational period in FY22, being extremely busy. Growth trajectory from a financial point of view, but also in terms of strategic events. So looking at below the arrow, we've had 3 acquisitions we've undertaken and a divestment. So we acquired Skipper Transport Parts, which added annually $18 million worth of revenue, which we'll get the full benefit of this year. We acquired the buying group of United Tools, which, if you think Metcash, we acquired the Metcash equivalent, and we've also acquired one of the stores. So we bought the local independent stores in Albany, WA. We won several new contracts, which was the first for the company, 18 million in annual revenue that will contribute in the next 2 years. When we acquired Skippers, we consolidated that into the same warehouse as one of our other operating brands, Heatley Safety Industrial. So we have warehouse configuration. We took a number of store upgrades, a number of e-commerce programs, as well as new premises. So that's about improving our branding, making sure we have a great customer experience and efficiency. Top of the line, we added 41 stores, which is significant, 22 new product categories. We increased our inventory, which didn't slow us down to supply the customer. Importantly, also, we had 70 odd people that have joined our business, which I've already mentioned women, but we also undertook a migration of the Skippers business onto a new ERP. So significant progress on our strategy, and an extremely busy year for our organisation. Next slide, please. Since we listed, this is just to put some perspective in terms of what we've achieved. So we've moved from 24 million to 100 million. Also in that time, we walked away from $20 million contract in Africa, which was low margin and high cost. So today, if we had held that, we would have been north of 120. We've gone from one location to 74, from 2,000 odd products in stock to 400,000, from 200 customers to a significant amount of consumers and customer base, similarly with employees and similarly with the number of suppliers. And all that gets anchored underneath the strategic framework that we've stuck with from the beginning, is following the 7 principles from having a balance of organic and M&A growth, good balance across geographic areas as well as business segments. We run decentralised organisations that are fully integrated. Synergies is very big in terms of what we do, as well as distribution excellence. And all that is wrapped up in ensuring that we have a long-term sustainable business that benefits our shareholders. Next slide, please. I put this up. Interestingly, it shows you the last 3 years from the 1st of July to 30th of June, where our share price moved in that time. On the top right-hand side, why do we say we're undervalued? Our current price is 13 cents. We've got 2 different measures, one from a paid research, Corporate Connect, which has put a fair value research report out on the 11th of July for 33 cents, and ANZ Share Investing have us down for 28. So clearly we're undervalued by somewhere between 55–60%. And clearly an organisation that's turning over $100 million today, and what I've just explained to you is significant in terms of its opportunity in the future. Next slide, please. So what are the key takeaways? We have built one of Australia's largest industrial distribution groups. A lot of that today is very embryonic, so the full benefits of that will materialise this year and next year. We work in highly attractive markets, which is large, $40 billion we've identified. The largest player in that market is a bit over 4%, which is a Wesfarmers business. We have an extensive pipeline that really sits well with strong business fundamentals. We expect midterm growth of a significant size across all our businesses, and in that we are growing market leadership. So we have a really good, true, solid business that has got plenty of upside in the future. Great, thank you, Tim. I'll hand that back to you.
Thanks, Mike. A couple of questions here. What's your current take on the underlying business conditions for some of your key customer industries?
We see them varying across a number of different areas, but really robust. I guess resources, infrastructure, construction, transportation is a big area of what we do as well. The building industry obviously has huge demand. So what we're finding is that everyday products is continuing to have regularity, but also there's a number of projects that are upcoming that we are going to participate in. And the beauty about our network and what we've been able to create recently is our products cross-selling across the whole network. And that means that we're providing more value to more customers that would traditionally come in for 1 or 2 items, now have a broader mix of what's on offer. So almost a one-stop shop type of offering.
And those acquisitions you spoke about, Skipper, United Tools, can you give us an update on the kind of integration of those businesses?
So Skippers we acquired in late August of last year. That's been fully integrated. We are in the process of cohabitating or merging multiple brands into store locations. And the reason why we're doing that is our customers are demanding us to be in those locations and their sales upside. The United Tools buying group acquisition occurred in March, and that's we started working with the top 40 suppliers across our group to bring that together to not only add leverage and improve commercial terms, but also to ensure that we have one support system that can feed the multiple operating businesses. And the Albany acquisition, we are looking to merge that with Skipper Transport Parts to cohabit one location over the course of the next coming months. All those businesses, except for Skippers has been flatlined. All those businesses have grown significantly above expectations. So, it's really advanced our business. There's been a lot of learnings, and our next phase of our acquisitions and integration will continue over the next 12 months.
And of course, Mike, inflation is affecting everyone. Can you talk us through how you manage that kind of cost inflation? Do you pass it on to your customers or look for internal efficiencies, for example?
Well, firstly, efficiencies for us is where we need to, we have invested, but also we continue investing. So what that will do is create a lower cost to serve, and that offset some of the inflationary pressures. From a labour perspective, clearly, labour costs are increasing, and the efficiencies, what we're finding, are offsetting the labour costs and the price of goods, or the cost of goods and the supply and cost of freight. We don't plan to push all of that across to our customers. We are pushing a reasonable amount, which is part and parcel of obviously doing business. We want to be with our customers for a long, long time. So we're working with them about how we can be fully integrated, how we can actually have a lower cost to serve model, how we can have a streamlined supply chain. So what that will do is bring down our operating costs, but also offsetting inflationary costs that come on. So we've grown from 18.5% gross margin in 2018 to 30.4% in 2022. That's up from 29.1, in FY21, and up from 26.6 the year before. So we've continued to increase our gross margin, and I don't see that changing in the immediate future.
Great, Mike. That's all we have time for. Nice to see you again. Congratulations on your recent success. We'll follow the story with interest.
Great. Thanks, Tim.